You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Jerry Parker and I, Niels Kostrup Larsen, are back with this week's edition of the Systematic Investor Series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we attempt to answer all of your questions. Moritz is out this week, so it's just you and me, Jerry. How are you doing?
Great. Good afternoon. How are you?
Yeah, no, I think I'm doing fine. I think we're both struggling a little bit with a cold, so bear with us today if you hear us sniffling or if you don't feel that there's the same level of energy in our voices, but we'll do our best. And by the way, if you're tuning in for the first time, welcome. We love that you are here, and we'll do our very best to inform and perhaps even entertain you about systematic investing during the next hour or so. Now, apparently, there was a Black Friday back in 1869 where gold and stock markets collapsed after being driven to record highs by speculators trying to corner the gold market. And then, of course, we had Black Tuesday and Black Thursday back in 1929, which I think a lot of people will be familiar with. Of course, the Black Monday in 1987 is probably still clear in some of our listeners' mind, where we had a 22.6% drop in the Dow Jones in one day. I think the biggest one-day drop still in history. But nowadays, we have Black Friday every year with a slightly different meaning, of course. We just had one. But from a trend-following perspective, this year, Black Friday coincided with the end of November, which looks indeed to finish in the black for all the usual indices that we follow, as well on our side for Don, adding to what currently looks to be a pretty good year for the industry. And in terms of my own trend barometer that I publish every day, it finished at a reading of 47, which is only slightly above the average that I've seen since 2015. The daily averages is around 42. So not a particularly strong finish on that. But I do think the industry probably had a reasonably solid month. And as I mentioned, since November is has just wrapped up, we can go through a little bit of the headlines that we encountered in our trading this month. I mean, from a market point of view, there wasn't a lot of sort of really noticeable market moves. But then when I look at the kind of the breakdown, we still had coffee prices go up by 20% or so, which on our side was the biggest losing position we had. On the other side, on the flip side of that, we had nat gas dropping 12% in the month of November, which was one of the bigger winners in the portfolio. But, you know, overall on our side, it was a month that was really led by the strong equity markets and a reasonably well-bid US dollar, which we both benefited from. And then, of course, offset in parts of a kind of a sluggish start in the fixed income markets to the month. They recovered a little bit towards the end of it. Commodities were pretty mixed for us in November. We had losses in metals. We made some money in meats and in the grains, and the energy sector was pretty mixed overall. So I don't know how everything panned out on your side, Jerry, for the week, for the month.
Yeah, well, it's pretty much the same. Coffee was a bummer at a big rally. I guess everyone wants to get long at these lows. Cocoa down, up, back down again. So that trade is looking like a lot of the other recent new entries for me. Just almost immediate, turning into a small loss. So hoping that gold and silver are going to keep rallying, and palladium is sort of the gift that keeps giving, is to borrow a phrase from Moritz. Dollar, awesome. Grains, short, they're good. So it's a mixed bag, but not a lot of good trends crushing it these days. I had a few stocks. I had a $15 winner in Target one day, good earnings, and then another day, $15 loser and Dollar Tree. So that's the way it goes sometimes.
That's the way it goes sometimes. That is true. Yeah, I mean, I guess we were a little bit spoiled early in the year where kind of every month turned out to be a positive month for the industry and for our programs and all of that. And then we've had a couple of sort of mixed months and kind of brought us back to reality. This is exactly how trend following is. And now we're kind of hopefully finishing on a strong note as we come into the end of the year, but also the end of a decade. And a decade where maybe some investors will sit back and feel that, oh yeah, I mean, that thing about diversification, that doesn't really work because I should just have been long only equities and nothing else. So, I mean, of course, we talk about diversification a lot. We know it's important. It's kind of a humility, it shows humility about an uncertain future. I mean, that's the only thing we know how to guard against, not knowing what the future holds is diversification. And I certainly believe that still holds up. It helps us minimize regret. I mean, most people don't like losing, or maybe put it differently, they hate losing a lot more than they like winning. So it helps us with regret. But of course, there might be some people out there, of course, we don't know, that still feel that diversification really isn't for them because, look at all the people who've been most successful in the world. The Facebooks and Apple founders and all of that, they've been incredibly focused in their endeavors, and that's paid off really well. So diversification is, I think, maybe something people are going to have to just think about how they want to structure their portfolios, if they see a place for what we do, trend following, in their portfolios as we enter into 2020 in just a few weeks. What about you, Jerry?
Well, just thinking about that, one of the most amazing things is that on a standalone or long-only basis, a lot of the markets that we trade, the currencies and the commodities, they don't really fit in well historically with adding diversification without materially reducing the performance. So with trend following wrapped around it, oh gracious, you can add in all these commodities, all the interest rates, longs and shorts in the bonds and the stocks, and you can really create this diversified portfolio, but not without the trend following. And I don't know, it's to us, it's been working. It's worked for a long time, and people need to get the message that in order to preserve capital and reduce risk and moderate your portfolio swings without really reducing your profit, you can add all these great markets, but not without the trend following piece. Trend following miraculously takes markets that are not good on a buy and hold and turns them into profit contributors to the portfolio, and lots of diversification. So are stocks superior to all these other markets? I don't think so, but it sort of looks like it recently, but that'll probably change as well.
Yeah, I mean, I still go back to this point about that there's never really been, or there has never been a white paper written that hasn't proved that by adding trend following to stocks and a stock and a bond portfolio, and that it improves the returns as well as reducing the risk. But of course, you have to put into that the little caveat about time frame. I mean, it doesn't happen every year. It doesn't happen every 2 or 3, 5 years maybe. But in the long run, it's still a great way of, building real wealth if you don't want to do what we do and that get into the nitty gritty of just focusing on trend following plus nothing, so to speak.
And that's why, it's so important for people who don't like trend following to go to the heart of the matter, which is it doesn't work anymore. So yeah, blah, 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 whatever you're saying, okay, you've got the papers, you can prove it, you've got back testing, but it doesn't work anymore. And that's why we have to counter that with, well, maybe we don't have evidence that it doesn't work anymore. So it's a really big battle, and it's a point of contention, and it's the issue. And so if it does work, then everyone should have their money in trend following, because you make about the same amount of money, risk adjusted, and with materially less drawdowns. And that's why it's so critical that if you're pro or anti, you can get very emotional and very extreme in your opinions on these things. So it's the issue. Is it going to start working again? Is it going to stop? Has it stopped? So
Right. I think that's the point. I mean, I don't think it has stopped working. I know a lot of people love saying it has, but I don't think it's true. And I think we have to, first of all, I think we have to stop being negative about the performance. The performance this decade for many of the best managers, is not materially different to what it was back in the 80s. It might be lower than the 90s, without a doubt. There's always going to be a decade that stands out. The same with equity markets, for sure. But certainly in our case, I would say this decade is above the decade starting in 2000, despite the fact that we had 2008, which was a great year in the 2000s. So no, it hasn't stopped working. But what people forget is that you can't compare just the CTA industry and the S&P and say, well, this continues to work, because in the S&P, and I don't know the hard numbers, but I think directionally I'm right on this one. It's such a few number of stocks that you can attribute all the gains that we've seen. You can pick so many stocks that hasn't done anything, or in fact has gone down a lot. So I mean, there are many. You wouldn't buy all the CTAs anyways. You want to find the ones that have done well and continues to do well, and that's just the way it works. But anyway, that was a little bit of a rant this today. Let's dive into our usual topics. How about some tweets from the last week of November?
I've got a few here. We had a fun week, high in quality, maybe low in quantity, but some good things to think about and talk about. Our friend Corey Hofstein had a video that I watched, came highly recommended, about diversification. And so it's mostly about stocks. And so I think that it's still some good lessons here. Of course, in my mind, I'm always thinking about adding those currencies and commodities in as well. But he starts by saying risk management begins and ends with diversification, but only if we embrace a holistic what, how, and when framework. Incorporating trend equity strategies may be a powerful way to introduce how and when diversification to a portfolio. So he's just basically saying, hey, how about this trend following thing? It really makes things better, and it adds some diversification. It's going to make a little bit less when stocks do really great. It's going to preserve capital when stocks do really poorly. But you have the stock piece of the different stocks, or the 500 stocks, long only. So let's replace some of that with some trend equity. It's a great term, So he's trying to get to the masses and say, let's don't talk about currencies and commodities quite yet. Let's just think about how great it can be if you add some trend to the markets you like.
Yeah, I think that brings up an interesting point, and that is, if we use the term CTAs, we know that that contains so many different things nowadays. But now the same thing can be said, I guess, about trend following. Trend following is many different things. So putting a label on it, like you just mentioned, trend equity, so it's very specific to what you do. I think that's a great way of going about it. Maybe we have to be diversified trend as a caption, because we that's what we do. So maybe in the next decade, we need to be a little bit better on our narrative and our communications, making clear what it is we do, so people don't get confused. But I did notice that Corey has been out with a few things in that area. I haven't myself studied it in detail, but I know that he likes trend, and also the people up at Resolve that I think he's worked with on a project in this regard. So yeah, if there are other ways people can find ways to include trend following in their strategy, in the way they look at the markets. We talk a lot about why we don't like trying to anticipate, why we don't like trying to predict. And I think what's been really tough for people who in this last decade who may have missed a big part of the bull market is just because they are being bombarded by information and people who are trying to predict. And their frame of mind gets influenced by that. and you can say right now, well, what, do you really want to buy equities at new all-time highs? But you could also just turn around and say, why not buy equities as long as you know where your stop is? I mean, what if equities will continue for another 20%? You want to be part of that, but you just let the price tell you what to do. And when time is up, it's up, and prices will tell you when to get out and potentially get short. So I think the more people,
That reminds me of a statement that someone told me when I first started Chesapeake. A client said, you should come in every day and answer this question, do I still want to be long or do I still want to be short? If you can't say yes, if this isn't a good trade today, you should get out of it. So I thought to myself, that sounds kind of true. I mean, kind of like a lot of things about cliches in the market, they sound kind of true. But, I'd always go back and say, well, I don't think my mentor has said this. And I wonder what they would say and why am I not equipped to answer this question? And so the fact of the matter is, I don't want to buy equities at all-time highs today. I wouldn't want to do that because my system bought them 6 months ago. So if I don't want to do today what I should have done 6 months ago, I want to have this trade on with lots of profit in it, having followed this trend in the bonds or the stocks or whatever I'm trading. And so I wouldn't do the trade today because it would be a mistake. I wouldn't be following my system. And so I think, a lot of these questions are, do you want to do X, Y, Z? Depends on what is your system telling you. If you have lots of profit built into this trade, then it's much better. You can sit still and enjoy it a lot more if you're following the system, and especially when the trade has a nice profit in it, versus being faced with this artificial choice. Do I want this position today? I mean, I have no idea. I'm not supposed to buy it today. I'm supposed to buy it 6 months ago.
Yeah, no, absolutely. Good start to the Twitter segment. What else was happening in your Twitter feed this week?
Well, I was focusing on Meb Faber a lot this week and listening to some of his stuff and reading his stuff. And there is a good podcast out there with Andreas Klenau, and I haven't got around to it yet. I took good notes. There's some controversial things in there. He's a trend follower, or he talks nice about it sometimes. And so, anyways, there's some different things in there that I think we can get into next week. I was waiting for the transcript to get it perfect. So, Meb, get that darn transcript out there. Every day I'm checking the website for this transcript. I don't really want to go by my notes or have to re-listen to it again. But anyways, we'll get to that later. But he did have this one kind of tweet that I thought was pretty interesting. It's about clients. We're always complaining about clients and they can't follow us. We're following the system. You need to follow us as we're following the system for you. And he says in this tweet, nearly every investor I speak to says they base their allocations to funds decisions on a process, not performance. And I think that is at least partially true when they're buying into a fund, but it almost universally not true when they're selling. It's all performance. Imagine someone saying, your performance is extraordinary, but I'm not comfortable with the process, so we're selling. They don't. Also, rarely people say process is intact, but strategy is getting crushed, so we're adding to our investment. That's kind of funny, right? A simple check is to add your sell rule discipline when the fund buy is made. You just say to yourself, I'm going to buy this fund, I'm going to buy Dunn or Chesapeake for this reason, and here's my sell discipline on both of those. Many funds and strategies can go 10 years of overperformance or underperformance. Does your process incorporate that fact?
I would say I've certainly seen some of that this year, where people who took time, did their analysis, and before making an investment. So they were studying, as you say, decades of performance numbers to get comfortable and to understand what we do. But then within, an investment horizon of only 12, 18 months, because it has been somewhat challenging, then they decide to reduce or redeem. So they have these completely two different ways of getting in and getting out of a manager. And it's a great shame that that's the way it is. And again, I think it goes back to what we often come back to, which is the behavioral side of things, right? It's they emotions play such a big role, unfortunately, in how we make decisions. But in finance, you have to really be careful with letting your emotions run. We always get more bullish towards the end of a bull market. We almost get more conservative towards the end of a bear market, and so we need to be careful with that. I mean, I've had Andreas Kleiner on the podcast before, and he's a great guest. He has his opinions, and as you say, they're not, as far as I recall, they're not 100% in favor of trend following all the times. But he does these things where he tries to dissect. Can you replicate some of the best track records by simple rules? And I think I did listen to actually Meb, who always produces great content, speaking with Andreas, and Meb actually was focusing a lot on Andreas's first book, Following the Trend, which is a great book to read if you want to learn about a little bit more about the nitty-gritty of systems, but without getting into the every single formula, so to speak, but just conceptually how you could replicate some of the good track records. And Meb was saying that Andreas should, and I concur with that, Andreas, you should really, if you're listening, you should really go and update your studies to see whether the way you were replicating the performance of some of these managers still holds true, or if these managers have actually evolved and performance since you launched your book a few years ago has started to deviate more. But that would be an interesting thing to see, and maybe one day we'll get Andreas to join us and talk a little bit more about that.
Yeah, well, I'm definitely going to tweet a lot about that, because he had some controversial things in there that, one of them was, which is, I've talked about this a lot, and I think Moritz agrees to some, I don't know about Dunn, but it's okay. In fact, it's okay. It's okay, but it's between us, between us guys here and gals on the podcast. It's okay. It's nothing negative to call ourselves speculators, number one, and then it's okay to look in terms of betting. We're kind of placing these bets in the markets, and he says, no, that's crazy. Okay, so we got a lot of controversial stuff to look into.
Yeah.
At a later date, I look forward to it, and boy, if we ever got him on the podcast, that would be fun as well.
Yeah, I'm sure. Last time I asked him, he had football training with his son, or football match. So we'll make it happen.
Yeah. So this is a kind of interesting. We've touched on this topic many times, and maybe even today. So this is from Morgan Housel again. Really enjoy his stuff. We'll never get rid of gurus, because assuming someone knows everything is easier than trying to figure out how they knew one thing. They let us pretend the future is knowable and the path forward is obvious. I think that's kind of a thing about trend following. You're really just shocking the worldview of the person who's not really into it and studied it and had a good experience with it. It's just a shock to the world that we're going to make money on, and we're going to lose on the majority of our trades, and we're not going to predict. And you're going to handle this trade every single time the same way. I mean, can't you do better than this? What am I paying you for? So I think this is just an eternal topic of predicting and pretending that we can kind of figure the future out.
I mean, of course, we remember back in the late 90s, early 2000, a lot of people had all these very bullish predictions about where the markets could continue to go, and of course, it turned out to be pretty much the high before a major, crash or whatever we would call it. But what I think is interesting with this is that if you're right, and if your predictions is right, why not just wait in any event, just for the price to tell you when to get in and when to get out? I mean, because you know that if you're right that the market will go from point A to point B, and let's say B is a lot higher, well, then price will tell you and guide you as to when that's going to happen. So I find it a little bit difficult for people who can't understand, as you say. I mean, I think a lot of people are shocked that we don't look at any news and we're just simply looking at the price. But it shouldn't be that surprising that works, because price will always tell you where you're heading.
Yeah, and I've said many times, how much better can they be? I mean, how much better can you just discretionary or use other inputs than price? How much better can you be to just know when to buy that low versus just, heck, wait for the thing to rally a tad and then get in and place your stop loss. And then another thing we have going for us that turns it all around, which makes a system almost impossible to beat. And we've seen these in studies by Kahneman, and we've tweeted and talked about it. And that is following a process and following rules every single time. That just puts you in another category. And your ability to take money out of the markets is just incredibly enhanced because you have a process and a system and rules. Because even if you get it right a few times, the chances are you're not going to be able to outproduce the price and following the trends with a stop loss and taking small losses with some other types of approach, that's may not work all the time.
And I think, there's a lot of evidence. I mean, there's been a few books released this year talking about systematic or quant-based investors who've been incredibly successful and taking out a lot of money, hundreds or billions of dollars, in one case, more than $100 billion following a quantitative process. But even if you just look at the rankings of the most successful managers right now within the broader hedge fund category, I bet you 90% of the top 10 are quant funds. We know from last week's talk that More Capital, Louis Bacon, which I don't know that they're quant-based. They probably use some quantitative analysis, but I guess they're kind of a more discretionary global macro manager, and how they are finding it too difficult to do what they do. So they're returning capital to investors. And this was interesting. In the conversation I heard this morning a conversation with Mike Batnick and Ted Seides about the state of the hedge fund industry, and we can talk about that later. But one of the things that Ted Seides said, who obviously knows the from an allocator point of view, the manager environment well, he says there's always, you can always find managers who are kind of under the radar, who don't want to be in the limelight, who don't want to be the biggest. They just want to focus on delivering really good, solid, above average return. But nobody, only a smaller subset of allocators will know about them. And that's exactly what they want. They don't want the big headlines, to be about them, but they have no problem in delivering that alpha still. And I think it's the same. We can find names like this in our industry for sure. Anyway, that was a little bit of a tangent, I guess. What else did you find, Jerry, this week?
Well, as I've said before, I feel like that I'm on a mission to read any sort of article, and I can turn it into something that's relevant to trend following or why trend following works. And so I found this article in the New York Times, and was one of the most popular tweets I've had, believe it or not. And the title of it was "The Zen of Weightlifting." And
okay.
So the quote I pulled out of there, it goes like this: to advance beyond the low-hanging fruit in any meaningful discipline, you must get comfortable spending time at the plateau, a form of purgatory. Keep showing up and pounding the stone. And so I feel like that's what a lot of traders and systematic guys feel like, is that we're in purgatory a lot of time, and we're getting criticized. We're out of the mainstream. We're trading crazy commodities and shorts and a systematic approach. Oh my God, can you please just limit it to one dumb thing or one crazy thing at a time? And we can't do it. So we're kind of in purgatory. We have very few people who are feeling it the way we feel it, like the stock people can kind of take comfort in each other's miseries. But I just thought it was pretty interesting that so many people like this, and sort of, I didn't even mention trading at all, but I had a lot of likes on that one.
Yeah. And I mean, keep showing up that's a great life lesson, right? I mean, in any industry you're in, but it certainly is very important in our industry. And part of the whole philosophy about taking small losses is that you can keep showing up every day and still, put on your trades and be, rather than shooting for the one or two big home runs of your career, but with the risk of you blowing up much before that they occur. So, that's always nice when you see an article like that seemingly has nothing to do with what we do, but then you find all these parallels along the way. So, that's a great one.
I also had it was a nice tweet from Wayne this week as well. And I've heard of this before, and I'm really confounded a little bit by simple systems or keeping things simple, but not too simple. And I dislike hearing statements that I can't get a really good feel for what the heck, is really meant by these statements. And Wayne starts out by saying 25 years of quant modeling wisdom in a nutshell. Quote, the goal is to master the balancing act of simplicity versus complexity, of establishing a core thesis that is profound, insightful, and interesting, and yet expressed in a single sentence. Don't be simplistic, but keep it simple. Oh my gosh, what does that mean? I mean, I can't figure out exactly what I can do with that. So what I did? I went to the dictionary. Yeah, that's exactly. I typed in simple versus simplistic. So this is what I tweeted. And this comes from, the Googling that phrase, simple versus simplistic. Simple is straightforward. Plain, easy, ordinary, or uncomplicated. A simple solution to a problem is usually a good solution. A simplistic solution is too easy. That is, it oversimplifies and fails to deal with the complexities of the situation. Okay. A little bit better. Then Woody, we triple teamed this subject here. He goes, using an algorithmic system that takes bets on both sides of all liquid markets is prudent because of its humility. Humility is the proper response to a game with infinite dimensions. Making long-only bets by the seat of one's pants is the most complex yet mindless approach.
I mean, I think this is kind of a blessing and a curse, right? Because I think the blessing is that that's what we try to do. I mean, in a sense, when we build our models, we tell people, don't overthink it. Good enough is good enough, and don't make it too complicated because it won't hold in the long run. You lose your robustness, etc., etc. But I think at the same time, as an industry, we've been probably using the word simple in the wrong way, because I think a lot of people have ended up thinking that what we do is so simple they can do it and it shouldn't cost any money. They shouldn't pay for it. So I think I don't want to use the word complex, but the real valuable thing we do is we take something that is inherently complex. I mean, financial markets are inherently complex, and we find simpler rules to extract profits over time. So that's the challenge we have. And I mean, of course, you can go to and read a book about like Jim Simons that we've talked about so much in the last month. That's not simple what they do, for sure. I'm not even sure they know exactly what they do because it's kind of machine learning stuff by now. So that's not what we do. We know what goes into the model. We know what to expect to come out at the other end. And I will say that certainly when I look at what we do on our side as a firm, the way we do things today compared to trend following maybe 25 years ago, I would say it's more sophisticated. I mean, there are more things that goes into the process, but we're still trying to make it a relatively simple process. But I will recognize that it is not as easy as it was 25 years ago in order to be successful. And I think if you look at those, if you I mean, in the very long run, it may not make any difference, right? Because you mentioned that as well. I mean, what if we just took a system with rules, 30, 40 years ago and did nothing and just let it run? I mean, can we beat that? Maybe not. I don't know. But I will say, I think that if you do that, if you keep it that simple and never really evolve, but just keep to some really simple rules, and there are maybe one or two managers that I know of at least that probably does that. I think the price you pay is not necessarily long-term performance, but it's the volatility it comes with. Then you can go back to David Drew's saying is that, well, the most volatile systems are the most robust, etc., etc. Okay, fine. So if you can live with the volatility, yeah, maybe you can do what we do in a relatively simple way, and in 30, 40, 50 years over that period, you'll do really, really well. But most people can't handle that volatility, and certainly on the client side, they don't want that anymore because they think they can get something that is much safer, lower vol, and gives you the same levels of return. And for short periods of time, that may be true. But in the long run, I mean, there is still a reason I believe that so few non-systematic trend-following managers have as long as track records as Chesapeake and Don. I mean, you just don't see them. But I think that I think trend following can be done simply if you're willing to take the volatility it comes with it. But if you've evolved a little bit and allow yourself to embrace, some maybe different techniques, newer techniques, whatever it might be, then it still works. But it's a little bit more complicated maybe than how we did it back in the 80s.
Well said. Well said. Oh, I was intrigued by this article from one of our competitors, trend follower. Oh, but they do other things as well. And this is just a lesson. Their experience in 2018 was a 23% loss. And so how are they doing this year? Well, they're doing really well this year. And he says in this article, we didn't change the signals or the portfolio construction methodologies. Us blaming tough times on market changes was to fall into retrofitting stories to the facts. They benefited as much from what it chose not to do as what it chose not to do. So I think it was a great article in the sense that sticking to your systems, not making radical changes, and not walking away from what you believe. Check it, look over it, make sure you still are happy with it. But you're just going to have these bad periods, and you need to stick with it. And this is something I wrote about last week about change has its own cost. Making changes, it may end up being a right thing to do over the long run, or maybe not. But at some point in time, the reason we work what we do, the reason we need to be so disciplined is because our day in the sun will come. So your inferior, slightly less than perfect system today, if you tinker with it, 2020 might be its year. I mean, I've had that happen where we wanted to make major changes after underperforming in 2012. And as we were contemplating making these changes in 2013, which we thought were definitely improvements, the 2012 systems were outperforming everything. So we kept delaying these positive changes based on our great research. So, it's just one of those things where wait it out a little bit, and there's just a cost. That's all I'm saying. There's a cost of changes, and there's a cost, I guess, of not making proper changes, especially if you're not diversified or taking shorts and things like that. So, but nothing is risk-free when you make changes.
No, I mean, that's really the challenge. And this is actually, I think this is really important. And I think exactly what you went through back then, which of course we've been through many times as well. I mean, that's the experience that investors pay for, right? Meaning, yes, you'll see newer managers with a shorter track record and their returns looks fantastic, right? But you cannot backtest experience. Impossible. And making those critical decisions, David Harding on record came out and said, I've decided to reduce trend, but I won't know until 10 years from now if that was a good decision or a bad decision. And that's exactly right. So super important, and investors shouldn't forget how valuable experience is, not just when it comes to making changes like that, how you handle big drawdowns. Do you panic? Do you just stick to it? I know we went on record, or our owner went on record in the there's an article written about Don in CTA Intelligence because of our 45th anniversary, and where he went on record saying, we never deviate from the system. But that's just us. It doesn't apply to everyone. Some people will make decisions along the way that are not necessarily based on the system, but that's just what has worked for us over the years. But it doesn't mean that it's for everyone. And of course, sometimes it comes with, more volatility than people would like.
Yeah, I think to some degree the positive and negative experiences in life, this is what I was thinking of when you were saying that, helps you just follow the system more. And so and there's other things, there's better research, or there's living through certain periods and trades where thought you were too highly leveraged or not diversified enough or too short term or too long term. Of course, these things will lead to good research projects and improvement. But I think to a large degree, the amount of the experience we have in the pros and cons of not following our system all the time are usually going to be cons, and they are going to make us feel better. But if you had a robot person who always followed their pretty darn good system and they didn't violate a lot of the rules of trading, then maybe, in hindsight, they could say, okay, I had no experience. All I did was follow the rules. I mean, well, that's a very unique person. So I think to some degree, the rules and the experiences that we have, if they do nothing other than force us to commit more to following a set of rules, that's a hell of a lot of good experience there.
Very true. Well said. I've got a few questions that we can dive into, but I'm happy to continue with any further tweets.
Oh, let's go to the questions.
Okay, cool. First question here is from Michael. Michael writes, so it's about this theme about sample size that we've talked about a few times. And not over-optimizing results due to too few trades. So one, he says, can the number of trades a system produces be used as a shorthand method for evaluating whether a system is under or over-optimized? If so, then is there a rough guideline for number of trades for a given speed? Example, system X trades 6-month breakout. Could we compare number of trades to a simple equation such as trades equals speed divided by year to tell us if a system is likely to have been over-optimized? Not entirely sure if I understand fully, maybe you do, what Michael is trying to get us to discuss here. I mean, of course, okay, so let me just say something here, Michael. Maybe it's helpful or not. Clearly, if you have a long-term system that only produces a couple of trades a year, you don't get a lot of you don't have a big sample size. Then you could apply the same rules to 100 markets or 50 markets, and of course you get many more trades to analyze. But I don't think. You have to take into account that there is the speed or the length time factor that. So you can't necessarily compare, in my view, that you need to have a certain amount of trades to have enough of your sample. If you're comparing a short-term system that produces lots of trades all the time and comparing that to a long-term system, you have to recognize that you're going to get fewer signals in the longer-term time frames. But I think nowadays, if you have enough data and enough markets in your portfolio to test, even if you don't want to trade all of them, because of maybe account size or whatever it might be, you should be able to go back far enough to get a decent sample size in terms of trades. And then you could also argue, and I know that argument, I've heard that from some of our colleagues in the industry, that they don't even go back necessarily to the 80s or the 90s right now because they think that maybe the last 10 years worth of data is enough to give you an idea of that. I don't know if I agree or disagree on that. I'd love to hear your view on that, Jerry. But and if you have any other thoughts for Mike regarding his questions.
Yeah, I'm not a fan of eliminating data. I think that's probably not where you want to go. I think sample size is so important. And, we've said many times trading shorter term strategies or as short as possible is preferable because you get more trades to look at historically. But the problem is some of the shorter term systems are not very profitable. So you're kind of forced to desire to make money and to have a profitable system. So you're going to accept systems with fewer trades. But I think one of the things about his question is I think that you just need the requisite sample size and whatever that might be in your mind or in your formulas. And then once you have that, I think you can move forward. And some of your systems may have more, a lot more than the minimum, and some may have the minimum. But probably deciding whether the system is robust or curve fitted is probably probably not what the sample size is going to tell you if it meets that minimum requirement. So I'm not exactly sure if I want to weight the systems or feel better or worse about the systems if they all have the minimum sample size requirement. I'll probably just trade them and not try not to trade those that don't have enough trades to look at.
Yeah. Well, hopefully that was helpful in some ways, Michael. Thanks for your question, by the way. And if you do want to send us a question, like so many people have done this week, we love to hear from you. Just send them to info@toptradersunplugged.com, and we do our best to bring them on the following show if we have nothing else special lined up, so to speak, as a guest or something like that. Anyway, also got an email from Richard down in Australia. Richard produces a lot of good stuff in the trend following world, and it was a long email, and we tried to get it into a question. I'm not sure we entirely succeeded in getting it into a question, but I do want to just make a little read a little bit part of the email that you sent, Richard. I think it's important for people. I mean, you build your own systems and a lot of them, and you say, I track the performance of the longer term funds that operate in a global diversified systematic trend following space and do not see any deterioration in the long term compound average growth rate post 2000 in this grouping. So I scratch my head in trying to determine what these analysts are seeing, unless they are cherry picking shorter time periods. As a wealth building exercise, any serious investor or allocator must look at the performance measures over the longer term horizon. Otherwise, how are they any different to speculative gamblers? So, but again, Richard, if you want to send us a specific question, we'll do our best to get that in, but we appreciate the support and all the stuff you do on your side. Then we have a question from Bing. And let me see if there was something in the intro I need to get into. No, let's go straight to the question, and that is, if a trader has a rules-based methodology that, one, generates a positive expected value, then applied over long term, the full business cycle that covers both high and low volatility regimes, and two, follows prudent risk control that risks no more than 3 to 4% of AUM per trade, then questions, one, does position sizing really matter? Why not go all in all the time on every trade signal if you can maintain prudent risk control of risking no more than 3 to 4% of AUM per trade? And two, during high volatility regimes, I found that it psychologically to be easier to scale into the positions rather than to go all in is maintaining psychological composure, the fundamental reason why everyone says sizing is important. And then he thanks us for the podcast. So thanks so much, Bing, for your question. I think this is an interesting one because clearly you have a different view on what risk tolerance maybe than what we have. And just from my perspective on this, Bing, I mean, the problem is that, of course, if we knew that all our trades were winning trades, yeah, you could certainly risk more. But most of the trades we do are still losing trades, and we don't know how they're going to show up. We don't know the sequence of how these trades show up. And therefore, even if they make money in the long run, if you get into a bad run where the sequence is lose, 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 and there's no winners in there, then risking 3 to 4% will basically put you out of business in a short space of time. That's the challenge you have. And this is why we keep saying trade small, because even if you see mostly winning trades in your system, I mean, that's fine, that's great. But it doesn't really tell you if that sequence is going to continue in the future. So you want to be careful. I mean, if you're only trading two markets, okay, fine. But if you're trading like we do, 50, 60, 100 markets, you just can't risk that much per trade, unfortunately. So without knowing those kind of details, that's hard for me to answer. About the high volatility and the psychological side of things. I mean, I think psychology is really important in any. I mean, certainly if you're starting out as a trader yourself, Psychology is what's going to trick you up, and in your emotions are what's going to make it really difficult for you to stick with the systems when you're in a 30-40% drawdown suddenly. So that's another reason why, and this is something that goes for investors as well. One of the reasons why our industry have become lower vol overall is probably because the types of investors that invest in these strategies, they don't want to see these huge drawdowns. We just can't eliminate them. We know they're going to come from time to time. And we probably think that if we keep trading long enough, the biggest drawdown is going to be ahead of us, not behind us. So again, psychology is important. If you end up in a situation where you can't stick to your system, that's a really bad place to be in. And that's another sign that you've been over trading. Anyway.
Yeah, it reminds me a little bit of when I first learned about trend following when I was in public accounting in the early 80s, and I thought, this is the greatest thing ever. I mean, this is the greatest thing I've ever seen. And I learned about futures and commodities and going short, and it was just check, 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 amazing. So I thought, I just put into my calculator, what happens if I compound 100% a year, every year? I was like, yeah, I'm going to be a very wealthy person. So I think it's great to have that, commitment and that question. It's kind of like, if this, then why not that? And so, this is a little bit more complicated. So I think one of the things that has happened, and this is just my opinion, and I've said it many times, it's the reason in order to make money for clients, we've had to become longer term. And the drawdowns are going to be larger, but the systems are profitable. And then, as you mentioned, in this age of low interest rates, zero interest rates, negative rates, the desire for a 10% return is much higher than a 20% return or greater with the accompanying drawdowns. So everything is leading us towards trading smaller because of the systems and because of the risk appetite that people have. And according to Moritz and I, the max drawdown should be around at least twice as much as the annual return. So I think in a nutshell, if you do a back test and you're risking 3 to 4%, at some point in time during the back test, you will have more than 100% drawdown. I mean, I think that's where the rubber meets the road right there. Or we'd be doing it and I'd be risking 1% or 2%. But I don't even do that. So I think that so maybe this person who gave us this question has a much better system, a way to implement a risk control overlay that prevents these major drawdowns 2 times the annual return. And so maybe that's where it all is, which I don't know how to answer other than I think 50 basis points is about right, given the look back period and the type of systems that I think are profitable these days have to be more 6 to 12 month look backs versus for me, it used to be, 2 weeks.
And of course, it depends on the system and the strategy, but it also depends on how many markets you trade. But hopefully, Bing, it was useful to get our thoughts on this. Next question is from Jacob. Jacob is happy about the explanations on ATR and risk management from the last few weeks we've done. Appreciate the comment, Jacob. And Jacob asked, I have a question regarding strategies that warehouse risk. Can you give examples of warehousing risk other than strategies that sell volatility? This is just my interpretation of it. But for me, a lot of these relative value strategies, like what we saw, I guess, with long-term capital, where they were trying to, make money from small inefficiencies, but with very high leverage. And it all looks very smooth until something breaks, something that hasn't showed up in the data set before shows up. And then suddenly you realize that you have a lot more risk in your portfolio than you ever imagined. And the whole thing blows up or nearly blows up in other cases. I think what I mean by that is that I think some of these strategies can look safe, but actually they are warehousing a lot of risks that you may not see. While what we do is we because we're directionally based. We mark to market our trades and positions every day. So we know exactly what the risk is, and we show that. It shows up in the daily volatility. They don't look safe necessarily to some people, but they're not risky. They're just, recognizing the risk on a daily basis. So that's what I mean, at least when I think about these strategies. A lot of them are the convergent strategies, meaning people who bet on stability of some kind. What we do in our strategy is referred to as divergent. So we're betting on change rather than stability. And I think for me, that's maybe one way you can differentiate between whether you're warehousing risk or whether you're recognizing risk on a daily basis.
Yeah, that's a good explanation. I think reverting back to the mean type things, I think could get into a lot of trouble and can show short-term or long-term profits, but they're sort of set up to really lose a lot, and so in a short period of time. So I would file it under the category the opposite of trend following: small losses, less than 50% winning trades, and big profitable outliers. So it's the opposite of that: more than 50% winning trades and small winners, and you get crushed on the potential outliers, and when it doesn't revert to the mean. Warehousing, I know that I read that on Twitter once. I'm not sure I fully understand that. Warehousing something, are they warehousing it? Maybe. I'm not sure what that means or if that's true, but it's out there. A bad thing is out there when you don't take small losses and you're not in gear with the trend and you're not trying to profit from large moves.
Yeah. Hopefully that was helpful, Jacob. Then we move on to Nathan. This question actually is in relationship to a question or a comment that Moritz made last week on last week's podcast about crude oil WTI. But I think we can answer it anyway, even if Moritz is not here. So the comment that Moritz was making was that he sees no trend in WTI as it just bounces in a range. And then you write, Nathan, but when I put up a chart, price has pretty much only been up for 2 months since the beginning of October. It made me wonder how we define or construct the parameters for a trend. Perhaps on a 240-minute chart, crude oil has a very easy to see trend, but on a daily or weekly, it becomes more convoluted. How can we reconcile the various time frames that show a trend versus those that have no clear signal within the same instrument? I think you kind of touch upon it yourself and answer it almost. It's all about time frame. It's how you look at things. What may be a short-term trend for some is nowhere near a trend for others. And I think since both Moritz, Jerry, and I, or with the firms we represent, we are long-term traders. So oil bouncing between $50 and $60 for a number of months, for us, it's not really a trend. It's a range. We want it to break out and move from 60 to 100 or from 50 to down to 25 again. That is something we can get excited about. But the good thing is there are lots of other managers out there who do the short term and play that side, and they may be enjoying what's been going on in crude oil for the last few months, and that's fine. At the end of the day, we're probably all trend followers to some extent. It's just a matter of how you define the time frame. But everyone needs some kind of directional move in one or two instruments, in order to make money. Most of people, certainly in the people where it's relative value, they don't consider themselves as trend followers, and neither would I. But they are looking at some kind of directional move. It's just in relationship to something else. We just look at it individually, and we want the market to move for a certain period of time, and ideally with a certain price move that is big enough for us to capture.
Yeah, I'd say that's using breakouts, and moving averages, and with a 20-day look back. I used to do that in the 80s, and it was great. It doesn't work anymore, but I think that some people who look at 20-day look backs, it does work for them, but they're not using the breakout or the moving average alone like I would or I did. So if you look at that, crude's rallied. I had a big down day after your question, I guess, was submitted Friday. But, if you look at the last big uptrend in 17 and that crashed towards the third quarter of 18, there was many 20-day, downtrends in that trend. So that's the problem. The markets are choppy. It makes a 20-day low. It doesn't mean anything. It goes back to the highs. It went back to the highs at least 3 times, in that year and a half trend in 17 and 18. So that's what you're seeing on these back tests is that the 20-day doesn't work. And so what's interesting, though, is, when you decide to lengthen your look back, what did you do? I looked at the same data that I looked at for the shorter term look back, and the longer term look back worked as well or better. Yes, and it continued to work over the shorter term data. So it wasn't that the long term look backs all of a sudden got profitable. No, they were always as good or better than the shorter term look backs. I mean, not risk adjusted, but they were making money and they were making profit. And the open trade profit now is more noise in the trades and the trends, and those systems are more noisy and have bigger drawdowns, but we've maintained to keep the profitability. I mean, that's your first rule, right? I mean, it's great to have a shorter term look back and more sample size and less drawdowns, but it doesn't make money. So that's the dilemma. What are you going to do? Lengthen your look back or something else? Vol target is popular. Money management overlay somehow, not robust, parentheses, but that's popular as well.
Yeah. Thanks so much for the question, Nathan. Hope that was helpful. Next question, all the way from Canada. Chat writes in, and again, thanks very much, Chat, for your kind words about the podcast. The question I would like to ask each of you is, how do you each go about building up to your full size in a given position once you get an entry signal? Are you simply all in based on your risk per trade, or do you start small with a quote-unquote feeler position and add to the trade as it goes in your favor? If you guys have any statistical backtests around this topic, I'd love to hear those thoughts as well. Let me start with you on this one, Jerry. I know we've touched upon this before.
Well, yeah, we've touched on this before. I set my max position prior to the trade. Yeah, so I know what my max position is going to be, and I sort of spread it out a little bit, but in a sense that I'll piece it in a little bit. A few different entries and exit points, systems that should probably most of the time get in at at different areas and then exit at different places as well. So that's how we do it. We don't really alter the plan or have a new plan once the trade gets profitable or the first 2 buys are profitable. We sort of know what we're going to do from the get-go. Sometimes we only buy 1 and it goes lower, and sometimes we buy 2 and then it goes lower, and sometimes we buy all 3 or 4 or 5, whatever, and then it still goes lower. So we piece it in and we lose on all of them. So such is life, but diversifying your time frames somewhat works well.
Yeah, so just to add to that, Chat, so essentially what Jerry's saying, and we do the same, so we know roughly how much risk we want to take on in a given market, right? So that's your starting point. And then the question is, how many smaller confirmations do you need in order to get to a full position? So we don't regard it as feeler positions or trades, but essentially the shortest time frames will be the ones that are get hit first, and then you start building your position, and the longer term time frames of your parameter sets will be the last ones to get in. So you just build it up following the rules. There's no magic to it. What you can say, I think, is there might be a bit of a difference in, so by only having, say, you could say the extreme, you could have 1 entry point and you get full all in, or you could have 20 entry points and you get in over 20 smaller steps. And of course, if you get into a great trend early on, that's obviously going to be better to get in straight away. But at least in my experience, doing it step by step, longer term, is probably the way to go about it if your account size is big enough to do so. Simply for the reason that if you have a lot of, and we will go through these periods from time to time where there's a lot of false breakouts or noise or whipsawing, however you want to determine it. If you only have 1 or 2 or 3 entry points, you can lose a lot of money in a short period of time, because you get fully in and then you have to get out again, and then you might get fully short and back again, and so on and so forth. So I think that's generally why we also on our side like to have a larger number of entry points. Now, of course, it doesn't mean that sometimes some of these points can't be hit on the same day, and you do end up getting in relatively quickly, but it's not necessarily how it's structured. And so just keep that in mind. Again, depending on a little bit of, again, on your system. I mean, if it's a shorter term system, you obviously can't wait for maybe had to have 20 confirmations. But if it's a longer term system like we trade, you can certainly have multiple entry points before you're at a full position. But still, the full position needs to be predetermined before you start building it up. So thanks for that, chat. Last question for today. It's a couple of questions from Chris, who has written in before. So nice to hear from you again, Chris. He starts off, I want to congratulate Jerry about his you know what this means, UVA football team beating VA Tech this week.
Oh, I was there. Thank you. I flew up Friday morning, 7 a.m. to Charlottesville. Got there within an hour before the game. Flew back Saturday morning. And I was wondering, in the fourth quarter, why did I do this? What a mistake. But, in all sports, Niels, you have to put yourself out there. You can miss a lot of fun once-in-a-lifetime events. Hopefully not once in a lifetime for this, but if you don't risk it, you've got to take some risk in life. And sports and the markets, you've got to put it out there and to get the reward. And so many times I have shaken my head, why did I put myself in this heartbreaking situation only to be rescued in the last few minutes? So that's what happened on Friday. So thank you. Yes.
Good for you. Good. All right. Well, then let's get back to the trading side of your question, Chris. I've been developing my system for years and been trading it live for months now. As the account grows, I add markets to the portfolio. I have a list of 30 markets that I want to trade, but the account size restricts the number of markets available. The spreadsheet that I keep indicates that when the system is running completely and trading in all 30 markets, there will still be a lot of money on the sideline. What should I do with this cash? And then that's one question. Second question, also, has the margin requirement for Bitcoin changed? I don't look at the margin requirements often, but it seems that the requirement went up substantially. So let's deal with the Bitcoin first, because I have no idea, and because we don't trade it. But Jerry, you may know whether it's changed.
I don't keep up with that. I know our margin requirements are low, 10 or 15%, and we put that cash in treasuries. It's sort of something that it's not that relevant. I think if you have that amount of money that's left over, then you should put that money in treasuries. And it's irrelevant, your margin to equity ratio, although if it's 40 or 50%, you're probably the same person taking that 3 to 4% loss per trade of your AUM. So trade smaller and have even more money that's going to earn interest. But I know that Bitcoin traditionally at the brokers have had high margin, short Bitcoin as well. I think that there's a difference between being long and short. I think short the margin might be a lot greater. But if we trade 80 markets or 90 markets and one of them is Bitcoin, one of them has crazy margin requirements, that's okay, right? We're going to not be worried too much about it. We're just going to pay that increased margin and not care because the other 89 or 99 markets have low margin requirements. So not an issue.
Yeah, no, absolutely. So let me put it this way, Chris. I mean, if you're just trading your own money and you have lots of cash still spare, I mean, that's a great problem to have. And as Jerry suggests, I mean, keep them safe. You may need some of it for margin later on, but keep it liquid, keep it safe. Now, if you're talking about it as a business, right, what Chesapeake has to do, what Dunn has to do, I mean, we have to look after hundreds of millions of dollars of our clients' money that we don't use for margin. So that for that, we need to have a real plan, right? So in our case, we use a cash manager. So, some managers do it themselves. In our case, we outsource it. And there will be some guidelines for what the cash can be invested in, which is typically government bonds or highly rated corporate bonds. The money that investors invest, you want to keep safe first and foremost. They're not the spare cash is not. We don't look at it as something that should produce a return. We need to keep them safe. We saw during the financial crisis that banks went under. Money market funds froze, et cetera, and you just don't want to be in a situation like that. So if you're a CTA and or any other hedge fund and you have lots of cash you need to look after for your clients, first and foremost, make sure they're safe. They need to be in liquid instruments, but don't take any chances with them. Don't get tempted by higher rates of return in some silly stuff. It's not liquid the day you need the liquidity for sure. So just stay with it in super highly liquid fixed income instruments. Yeah. Okay, those were the question for this week. I will quickly go through the performance, which will almost be the performance for November, not quite, because this is as of Thursday evening. So we still need Friday to know how the month finished. I think directionally we'll be fine, but I think Friday was a bit of a down day, so you're probably going to have to subtract a little bit from the numbers I'm going to go through, and then we can see, Jerry, if there's any more freestyle content we want to dig into afterwards before we finish this week. But anyways, the Beta 50 index as of Thursday was up 1.22 for November, up 741 for the year. SocGen CTA index up 1.26 for the November, up 7.34 for the year. The SocGen Trend index up 1.63 and up 10.7 for the year. The SocGen Short-Term Traders Index looks to have a good month, up 1.10, up 3.18 for the year. And the Bridge Alternatives Index up 1.85% for the month of November and up 10.49 year-to-date 2019. So we're still 1 month still to come before we know how the year ended. Since it's just you and me, Jerry, do you have any thoughts, ideas, topics, spur of the moment, something you want to bring up?
I think next week I want to spend some time on some articles and papers that came out this week concerning shorts, and maybe shorts or drag. And we talk a lot about shorts on this podcast and how much we love our short trades, and they add diversification and risk control. So there was an article, a paper out recently that the study was shorts are a problem, don't do shorts. So maybe it was stocks only. Maybe that's the case for stocks, but I'll look into that more, and we'll talk maybe more next week about shorts in general.
I think that's a great idea. By all means, send it to Moritz and I, and we'll do our best to read up on it as well. But I think that's a good idea to have some topics. I actually met with some people we've been referring to a lot this week, the good folks at Epic Capital in Dublin. And they, of course, are the authors of a great recent paper on deals with some of the challenges that our industry has been accused for being subject to. I think I managed to get a bit of a buy-in to get one of the Appy folks to come on the podcast maybe before Christmas, who knows, or maybe early next year, to talk about that a little bit more in depth. I think it's such an important piece of research that they've done. I encourage everyone to get a copy of it, read it. But anyway, let's hope we can discuss that in more detail as well. And of course, if you have any other ideas, I know we had a couple of suggestions to get Andreas Kleno on the show. So Andreas, if you're listening, reach out. Let's get it going. Otherwise, I will reach out to you. Yeah, any other things that you think could be fun, interesting, educational? We're open-minded to this. So, with all of that said, let's wrap up this week's conversation. We hope you have enjoyed it. And if you like what you heard, of course, we are always very grateful if you would leave us a rating and review in iTunes. They really do help. And of course, you can share these episodes with a like-minded friend. One share is fine by us. So from Jerry and me, thanks so much for listening. And we look forward to being back with you on the next episode of The Systematic Investor. And in the meantime, have a great week and a good start to the festive season.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next